Hey, what's happening? This is Jerry over at Wealth Dynamics coming to you live with our daily money clip today. I want to answer a question that I got from a client of mine. Again, it's why don't I invest in dividend producing stocks? Now, in order to go over this, I want to actually share with you uh, what this looks like on my whiteboard here. So you can see the difference in the numbers and the math. So the first thing is, again, I don't invest in anything if I don't like it, if I don't understand it, if it doesn't fit me, and if it doesn't fit my goals. Okay. So to reiterate, before we jump into any numbers, I don't like stocks. Okay. I was a financial advisor and I can't even tell you I understand stocks, right? Meaning I had licenses to sell them and broker them and all this stuff. And I can't even legitimately say I understand what they are. Okay. I don't know the definitions, doesn't mean I know what they are, which means probably most of these people watching also don't know what stocks are. They don't fit me and they don't fit my goals. Now, I want to share with you why on the final two questions. So, when I'm investing, okay, I'm investing for passive income. Okay, passive income. This means that I want to put money into an asset and I want to have that asset produce income for me month after month after month after month. Okay. Now, on passive income, the main terminology that we're looking for here is called a yield. A yield. A yield means that if I put in, let's say, $1,000 and I'm earning, let's say a 10% yield, then this is going to pay me $100 a year. Right? So the name of the game when I'm trying to get passive income is how can I get a higher yield, right? Without getting a bunch of extra risk. Okay. Because typically when I increase returns, I also increase risk. So with real estate, I can do that. I can buy a property. With private lending, I can do that. I can loan money for a property and then I can have that property paying me, rent if I own it or, interest if I'm a lender. Now, the problem with stocks, or as I lovingly like to call them, stonks, is the average yield on a stock is only 2.22%. Okay. Now, let's say that my goal to be financially free is $20,000 a month. If I can get $20,000 a month coming in, I can be financially free. Okay, that's $240,000 a year. Okay, kind of a decent number, not too big, not too little, 240 a year. Now, if I do a private lending deal where I'm making 10%, then I would need to have $2.4 million invested at 10%, and that would pay me my 240 grand. Now, if I'm investing in stonks, even if they're dividend producing, this 240,000, in order to generate what I need from this, I would have to have $10,810,000 invested at 2.22% to pay me the 240 grand a year. So let me ask you if this is about speed, because I want to be financially free now, not when I'm 70, right? If this is about speed, which one is faster for me to do, 2.4 million or 10 million, right? 2.4 million all day long. Why would I spend 5 times longer to get the same number just because I want to invest in assets like stocks? Now, the other thing I'm going to jump into really quick before we wrap up this daily money clip is with stocks, I have almost no downside. Or unlimited downside. With real estate, I have almost downside. With stocks, I have unlimited downside, meaning I can literally lose everything. Okay, a stock is paper ownership. It's a certificate that says I'm a common owner in a company. So if I own stock, it means that if this company can't pay me, too bad. I have no right to anything. If they go bankrupt, they pay their taxes before they pay me. They pay their wages before they pay me. They pay their secured debtors before they pay me. They pay their unsecured debtors before they pay me. They pay their preferred stockholders before they pay me. And if there's anything left, then I get some. Okay. That is unlimited downside. There's no asset backing it. Like with real estate, I do a lot of private lending with real estate. If they don't pay me, yeah, it's not ideal, but I can go foreclose and take away the property. So I actually have some kind of like a downside protection because no matter what, I'm always going to have the value of that property. So this is why I don't invest in stocks, even if they're growth stocks. 2.22% again is the average dividend yield. You can get higher or lower than that, right? Now, the other factor is manipulation. Stocks are very manipulated. If you look at 2020 from March till now, all of the market performance is based on the printing of money by the Federal Reserve. So I don't want to do it. I don't want anything to do with something that can be manipulated that easily. And so that's a big reason I don't invest in stocks. Now, I hope that that makes sense for you. Again, this is a game of building passive income and doing it as fast as we can with the most amount of return and the least amount of risk. And stocks just don't provide that. So thank you all for watching. Make sure you like, share, subscribe. If you want to get a free copy of my book, How to Create Wealth, you can go to jerryfetta.com. Again, that's jerryfetta.com. You can learn more about why I don't invest in the stock market, what I do instead, and how you could do it too. Have a great day. I'll talk to you next time.